G'day guys, this is Jax Milan, the Wealth Mentor, and this is a run through of a credit card rewards calculator case study that comes off the back of our two blogs that we created around AMEX and credit card rewards programs. Now, this is a very hotly contested subject that people are very, very passionate about because I think we all want to believe that there is a way to game the big banks and the financial institutions in order to take them for all they are worth. But the harsh reality of this is that we've crunched the numbers and there are very few individuals who actually win off the back of these programs. I want to show you the numbers and show you exactly how you can adjust the assumptions in order to see if you are likely to win in these particular scenarios, or if in fact this is costing you far more than you truly think. Now, if you're interested in finding out more, jump onto our website and search for the AMEX rewards programs. We did one that was an empirical report and case study, and we did one with our own money. We put basically over $1 million on the line to actually calculate the impacts in real world of how these strategies actually play out. So let's get stuck into it. Now I'm going to share my screen and I'm going to run you through this. Now, even though I did the case study, I put together all of the numbers, people questioned my logic. So I've gone ahead and built a calculator. This is something that we love doing. We love looking at the numbers and seeing what the actual story tells us, because ultimately this is about making informed and educated decisions based on the underlying financial model. So let's run through it. Now, the case study that I'm going to work through is looking at a couple of considerations. First and foremost is understanding the impact of what we call mental accounting. What is the threshold for overspending based on research of people that use a credit card versus using their own money? Research shows that on average, individuals spend between 15 to 30% more when they use a credit card compared to when they spend their own money. The reason for this is because they perceive it as not being their money. They perceive it as having an interest-free period, so they kick the tin down the road. They also perceive the value of the points, and as a result, this changes their spending behavior. We have tested this with our own clients, and we've found that to be about 15% on average. So we're going to assume that we're spending 10 grand a month on average, that we hit that spending threshold of 15%. Now, you can, of course, adjust this based on your own situation, and we can adjust the analysis period, which in this case, we're looking at 10 years. Now, what we're going to look at is a basic credit cards program. What is the points per dollar? We're going to assume that we're using an AMEX rewards program, so we're going to go 2.25. We are going to assume that AMEX points are worth 1 cent. If you have seen recently, if you're using your AMEX program for flights, the vast majority of aligned airlines have decreased the value of their transfer points by about 33%. So for example, we used to be able to transfer points. 2 AMEX points would equal 1 Qantas point, and that is now going to be 3 AMEX points to 1 Qantas point. So that, and there's other aligned airlines. Make sure that you go and do your own research to look at that. Now, of course, the Platinum card, which is the kind of holy grail of credit card programs, the annual fee is $1,750 per annum, okay? The interest rate on that, if you do, because it's a charge card, is 20%, and we're going to assume that we pay it off monthly, okay? Now, what we're looking at is on the basis of the additional spending, well, what would happen if we actually used our own cash, but then took that 15% extra spending and put that into an investment? And we assume that that produces an annual return of 8%. Okay. And then we're going to look at the same scenario based on a business scenario of looking at if we spend on average, let's call it 100 grand a month in the business, same thing, 2.25 points per dollar of spending, the annual fee, the baseline, and an optimized, the interest-free days and inflation. And we're going to look at the time value, because what people overestimate is how much time it actually takes to go and do the research on the flights to be able to make sure that you can get the most value from your points, to make sure that you're not overspending. There is time required. So there's an initial setup of 5 hours. We're assuming that there's a quarterly planning of 2 hours, and there's a monthly review of 1 hour, and we're going to assume your hourly rate is $100 per hour, okay? So these are our assumptions. I'm going to share this with you. You're going to get this as a resource on wealthhealthcheck.com.au. Complete the financial performance scorecard, and this will be on the bonus page. You'll get a copy of this video, and you'll also get the calculator that you can play around with until you are blue in the face. So let's go through my math. So we're looking personal spending first. Now, let's assume we've got this baseline spending, 10 grand. The overspending amount on a credit card is calculated at $1,500. which means that on average, our spending is going to be $11,500. Annually, it's $138,000, and over 10 years is $1.38 million. Okay, the points we earn is 25,000 points a month. If we look at the gross rewards value, that means that we're getting $259 in points per month. However, if we look at the monthly breakdown of the annual fee, that's $146, which means that it's making us $113 per month in net rewards. Okay, so it's $1,300 a year, or it's $13,550 over 10 years. So when we look at the calculation, $1,500 extra spending for $113 of rewards, it's a net loss of $1,387. It's 16 grand over the year, or 166,000 over 10 years. Doesn't make a lot of sense to me. Okay, now let's make some adjustments. What happens if that was only a 10% extra spend? Okay, what impact is that going to have? Well, of course, this starts to bridge the gap, and this is where some people find themselves. They're like, okay, well, look, I'm getting this net benefit, but because we're overspending, it's still costing you an extra $107,800 over the course of 12 months. Okay, so let's put this back to the 15% so we can look at the cost benefit. So let's look at the alternative. We spend using our own cash. We implement the cash flow system called the hub structure. It holds us accountable to making sure that we're only spending what we expect to spend and that we're maximizing our surplus. So we assume that we keep our spending on track at 10 grand a month. And that means that we're not overspending by that 1,500. So that's an extra $18,000 a year that we could be putting into investments. Okay. Now, if we look at that future value over 10 years, that is $274,419. And that's made up of $180,000 in invested and $94,000 in investment growth to take us to that total amount. So when we look at the comparison here side by side, we look at credit card. Total spending would be $1,380. Our rewards over 10 years would be $13,550. The actual cost here is $180,000. So our net position is negative $166,000, right? Like for what? You're going to get an extra business class flight a year. The reality is the vast majority of people don't even use all of their points. Compared to we use our own cash, 1.2 million. We actually have a value here of 274,000 because we've invested, which means we're in a net position of 274,000. So we're talking about a net differential of $440,000 over 10 years. It just goes to show the cash flow strategy wins. So what if we made some different assumptions? Well, what if we assumed that 10% that we were talking about before? Okay, let's look at the comparison. Well, still, you're going to be negative 107,000 compared to plus 182,000. Well, what if we didn't overspend at all? Zero. Well, the reality is at that point, we're not going to have any money invested. So therefore, they're not going to have any benefit from the cash investment because let's assume that we're spending same dollar for dollar. Of course, we might have extra surplus, but we're trying to look at the cost benefit here. But still, just because of the costs of the rewards program, your net position is still going to be negative 9,500. So once again, the credit card strategy here wins. But it's like, well, it's $9,500 over 10 years. Is that really worth the effort? Okay. Let's have a look at another scenario. Let's have a look at a business scenario. Because the reality is, unless you're spending $50,000 a month on the business rewards programs, you're probably not getting a lot of benefit. So if we're looking at a credit card rewards program at $50,000 a month, you're getting about $979 a month of value. Or about $11,000 a year. It's $117,000 over the 10 years, which is decent, right? Like that, yeah, that's where we start getting our business class flights for you and your partner per annum. But we've also got to be mindful of fringe benefits tax. But if we do overspend, then this is obviously going to have a significant impact. Like still, we're talking about a net loss of 762,000. And a net gain in the other scenario of 1.3 million. So there's a differential between the two positions of 2.1 million. So the assumption here is because the value of the points is so low, your threshold for overspending is in the vicinity of about 2%. Okay. Like even in that scenario, we're still going to be in a position where we could significantly improve our position by just having that extra 2% invested elsewhere and basically creating your own credit card rewards program. We've got to realize banks and financial institutions are not in the business of losing money. The rewards programs are very intelligently architected to use behavioral finance against you, to get you to spend more money so they can charge you more fees that exceed the value of the rewards. Okay, so something to be very mindful of. So let's just look at the pure business scenario here, okay? So we're looking at the scenario whereby we're spending $100,000 a month. So as a result, we're getting about 225,000 points a month. That works out to about 2.7 million points per annum. So the value of the gross rewards, assuming 1% per point, is about $27,000 a year. If we remove the rewards fee, considering that we don't overspend, like when we did this experiment in our own business, we only used fixed expenses, so it was primarily subscriptions and it was Facebook ads and marketing expense that we'd already budgeted for. There was no discretionary spending. It was money that was already in the budget. So the risk and the tolerance for overspending basically wasn't there. We put safety limits in place, okay? But we've also got a cost, right? So there's a cost of the fee, $1,750. So that's $25,000 a year of net rewards, okay? Now, there is also a cash flow benefit. So what we need to understand is that because of the time value of money based on inflation and the 55 days interest free, if you're spending $100,000 on the credit card, you are going to get $5,425 of cash flow benefit because of the time value of money. However, there's also going to be a time cost associated with you investing the time in this. So this basically then means, okay, we have a baseline benefit assuming 1 cent value per point of 28,000 and an optimized benefit of 55,000. Okay, so in this particular scenario, it might make sense. Okay, but what we've got to understand is like, okay, well, we've got our annual time cost, 2,500, our annual fee, 1,750. So the cost we need to cover is going to be 4,250. So in order to validate this, as based on the point value here of the value per dollar spent, we need to spend $188,000 a year, or about 15 to shy of $16,000 a month, in order to justify this. So if your annual spend is 600,000, then it may be worthwhile. If not, it's not worth your time. And then this is about understanding the tolerance, okay? So if you've got annual net rewards, in this particular case of $12,000, if our base annual spending is 600 grand, our overspending here is 2%. We can put in what our current overspending is. This gives us our margin of error, and this gives us our tolerance. So it allows us to start doing some calculations to work out, are we actually going to be likely for this to be a net benefit? Keeping in mind, most rewards programs provide you a reward between 1 and 2% of spending. There were ways to game this where it was higher before. Now it's about 2%, which means we have a threshold of 2%. If we overspend by just 2%, okay, like if you go from spending $100,000 a month to $102,000 a month, you've eroded all of the benefit. So for the vast majority of our clients, when we go through this analysis, it just does not make sense. And what we end up doing is we look to set up the cash flow structure that ensures that they can set up their own rewards program. What we do is we set up the cash flow structure. We carve off 2% and we put that into a separate account that's called rewards. There is no impact for fringe benefit tax. Okay, so what we've got to be mindful, these points are business assets. You cannot use those business assets for personal reward without considering fringe benefits tax, which is taxed at 47.5% of the value of those rewards. Okay, so if you're using your business points for personal travel, then you've got a big risk of getting hit with fringe benefits tax. Sure, you could, how long are you going to get away with it? But the data matching with the ATO is getting so good and so sophisticated that the likelihood that you are going to get picked up is increasing dramatically. So the reality is, like, how much value are you going to get from this? As opposed to, if we just carve off 2%, put that into your own separate account, and you can use that money for whatever you want. If you want to fly business class, you can fund it. If you want to pay it out as a dividend to go and invest, you can fund it. If you want to reinvest it back into your business, you can fund it. If you want to use it as an emergency fund, you can fund it. Whereas points, the rules can change, and essentially you've got no real control in the future of the value of those points, whereas you can control the value of your cold hard cash. So this is how we use pragmatic financial principles and systems in order to make informed and educated decisions, whether it be about whether we use a credit card or not, whether it be about reinvesting back into the business or distributing to build wealth, whether it be investing in shares or property. We have financial models that allow us to crunch the numbers, and to make pragmatic, rule-based decisions that get your emotion out of it and also minimize the amount of bandwidth that you must invest to make decisions. Because when you're running a seven-figure plus business, the sheer volume of decisions is what is going to lead you to decision fatigue and leaving opportunities on the table. So I hope this was valuable. If you've got any questions, feel free to reach out to us, and look forward to catching you on the next video.